Hi, I'm David Giarracciotti, Editor-in-Chief of wealthmanagement.com, which is a digital resource of Rep Magazine and Trust and States Magazine. With me today is Kevin McDevitt.
McDevitt, yeah.
McDevitt. Oh, so hard for me. I don't know why I got the name Giarracciotti, who's a research analyst at Morningstar, and we're here at the Morningstar conference. We're going to talk about fund flows and what they mean. Fund flows are a funny thing because, so basically investors, it appears that retail investors have been selling U.S. domestic equity stock funds for 5 years, basically.
Right.
They've missed some. They've missed a nice rally.
Yeah, unfortunately that's the case, and that's often the case, right? I mean, for a lot of people, retail flows are a negative indicator, really. I mean, it's really a contrarian signal for a lot of people. I think what tends to happen is investors are looking backwards at recent performance and investing based upon that.
Right.
They're not looking at the fact, for example, that the 10-year Treasury has a lower yield than the S&P 500.
Right. So it's sort of like naive forecasting. What's going to happen today, it's going to happen tomorrow and indefinitely. That's what people do.
Yeah.
And it's kind of sad, but that's the way. I mean, how do financial advisors have to fight against that?
They do. Yeah, I think the difficult thing is to try, and as an advisor, you're trying to get your client to see the difference between risk and volatility.
Right.
And I think for most individual investors, volatility is risk.
Well, that's right. I mean, hasn't been taught that way in MBA schools. I mean, it isn't.
Well, if you think in terms of standard deviation, which is volatility, a lot of people equate standard deviation with risk. That's really not. It's just a volatility measure.
Upside volatility is pretty fun.
Yeah, that's great. But again, of course, especially these days, you have an aging population, more people focused on income and more focused on capital preservation. I think that's part of it too. It's not purely sentiment. There is a demographic element to it. And I think the fact that you've had in 10 years 2 bear markets and a flash crash and a credit crisis, you can at least empathize with with the move out of equity funds.
Right, but what's going on with? It appears that you're selling large cap U.S. stocks, and then throwing them at emerging market mutual funds. That doesn't necessarily.
I think there are two things. Yeah, it's a good point. And there are two things going on there. One is you still have very strong 10-year returns, even though emerging markets had a very volatile 2011, especially on the equity side. You still have very strong 10-year returns. I think people still look back historically and look at what are the trailing returns. Plus, they've been just told for years that emerging markets are where the growth is.
Right.
And even though there's not necessarily a strong correlation between GDP growth and equity returns, that's still how most people look at the world.
Yeah. Well, that's what you're taught, kind of. I mean, and then now, what about emerging market debt funds?
Yeah, it's all the rage these days.
Yeah.
And I think actually there really is a good core argument to be made there. I mean, ironically enough, now today the higher credit quality countries are often in emerging markets. After the '98 Asian crisis, you really had you had those countries in Asia. They had a chance to rebuild their balance sheets.
Right.
They had export-led growth. They've had improved credit ratings since. Whereas in the developed countries, you've had worse credit ratings.
Right.
And so really, it's a way of diversifying, getting exposure outside the dollar. But you do worry that people don't necessarily understand what they're getting into, because returns have been so strong.
Right. Yeah. People go for that gross number.
Right. Exactly.
And the rest be damned. So.
Yeah.
Well, listen, Kevin McDevitt, thank you very much for joining us today. Again, we're here at Morningstar Conference, and thank you for watching.